Dear students, in the previous video, we had discussed the preparation of common size statement of profit and loss and common size balance sheet. Now, we are going to discuss another tool of financial statement analysis, the accounting ratios. Ratio is an arithmetical expression of relationship between two related or interdependent components of financial statements of an accounting period of a company. It means when a relationship is established between two variables in numerical terms, it is termed as a ratio. Ratio analysis as a tool of financial statement analysis describes the significant relationship which exists between various items of a balance sheet and a statement of profit and loss of a firm. It is possible to assess the profitability, solvency, and efficiency of a firm through the technique of ratio analysis. Ratios can be expressed in many ways. It may be in proportion, in pure ratio, and simple ratio, in times, percentage, and fractions. Now we will discuss in detail the various expressions of a ratio. Proportion. It is expressed by the simple division of one number by another. For example, if the current assets of a business are rupee 2 lakh and its current liabilities are rupee 1 lakh, then the ratio of current assets to current liabilities will be 2:1 or 2:1. Here we had divided current assets with the current liabilities. Times. A ratio can also be expressed in number of times when a particular figure is compared to another figure. For example, if a firm's cost of goods sold is rupee 1 lakh and average inventory is rupee 20,000, its inventory turnover ratio will be 5 times. Here, the cost of goods sold of rupee 1 lakh is being divided with the average inventory of rupee 20,000 to arrive at the figure of 5 times. Here, the cost of goods sold is 5 times more to the average inventory. Percentage. It is another form of expressing ratios. In it, relationship between two numbers is expressed in percentage. For example, if the gross profit of the business is rupee 10,000 and net sales are rupee 40,000, then the gross profit is 25% of net sales. Here, the gross profit of rupee 10,000 is being divided with net sales of rupee 40,000 and is multiplied with 100 to arrive at 25%. When this division is being multiplied with 100, the ratio will be expressed in percentage. A ratio can also be expressed in fraction. For example, ratio of fixed assets to share capital is 3/4, that is 0.75 times, or can also be expressed in pure ratio 0.75:1. Ratio analysis serves the purpose of various users who are interested in the financial statements. It simplifies, summarizes, and systematizes the figures in the financial statements. On the basis of this, there are various objectives of ratio analysis as a tool of financial statement analysis. To provide a deeper analysis of the profitability, liquidity, and efficiency levels of the business. To provide information for making cross-sectional analysis by comparing the performance with the best industry standards. to know the areas of business that need more attention, to know about the potential areas which can be improved with the efforts in the desired direction, to provide information derived from financial statements useful for making projections and estimates for future. These are various objectives of ratio analysis. Now the classification of accounting ratios. The accounting ratios are classified into four major categories. The first is liquidity ratios. Liquidity ratios brings out the ability of the firm to honor its short-term obligations. Under the liquidity ratios, we have to calculate current ratio and liquid ratio, also known as acid test ratio and quick ratio. Second is solvency ratios. Solvency ratios are being calculated in order to assess the long-term financial position of the enterprise. Under the solvency ratios, the following ratios are to be calculated. Debt to equity ratio, also known as debt equity ratio, total assets to debt ratio, proprietary ratio, and interest coverage ratio. Third category is activity ratios. These ratios show how efficiently a company is using its resources. Under the activity ratios, the major ratios to be calculated are inventory turnover ratio, trade receivables turnover ratio, trade payables turnover ratio, and working capital turnover ratio. In the fourth category, in order to measure the profitability of the firm, the profitability ratios are calculated. Under the profitability ratios, the major ratios to be calculated are gross profit ratio, operating ratio, operating profit ratio, net profit ratio, and return on investment. In the next video, we will discuss how to calculate the various types of ratios. Till then, thank you.